I think the bond market will continue to leak until such time as we get economic weakness, or if we had some stock market weakness that got triggered for whatever variety of reasons, and the weakness was enough to trump the passive bid, you could get stock market weakness, and then that people would presume that economic weakness was coming, and you get a decent rally, and that maybe there'd be less inflation, so you could get a decent rally in the bond market. But other than that, I think the bond market's going to be under pressure until some kind of a crisis get you know gets people to change their minds a little bit, or if the crisis gets big enough, eventually, then you can actually try to solve things, as I've just stated. But I don't. There's nothing there now, so I think the path of least resistance for the bond market is lower, which is to say rates are going to move higher. Now, maybe Bessent will come out with something that'll get people excited, and we'll have a knee-jerk rally. Sure, that could happen, but there's going to be no meaningful lowering of rates from, call it, 7 years and out. I don't believe, unless we get like some sort of, like I say, some weakness.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Bill Fleckenstein. So Bill is a professional money manager with over 30 years of experience. He writes a daily column and the author of the Greenspan Bubbles, The Age of Ignorance at the Federal Reserve. So Bill, thanks so much for coming back on the podcast.
Thanks for having me back, Anthony.
No problem. Looking forward to speaking. I will always enjoy your insights. And I'd like to start very broad and just what are you currently seeing in the markets? It's been a pretty volatile ride the past few months.
Right. I think a number of things that have occurred were somewhat predictable based on a potential Trump victory, which looked increasingly likely, let's call it October or so, maybe late September. And so a lot of the same things that happened when he got elected last time have unfolded. And what is clear is that he's much more prepared this time than last time, has surrounded himself with much better people. And that has released animal spirits, which is not surprising. Stan Druckenmiller made the point a couple of days ago. He said something to the effect of, we've gone from the most anti-business administration to the most pro-business administration that I've seen in my lifetime, the biggest switch. And I think that has shown up in the small business survey. And so animal spirits are in the process of being released, on top of the fact the Fed's cutting, although they're still doing QT at the same time. And of course, the passive bid is still out there. How do I say it? Distorting the stock market. So the forces that have been at work, that have pushed equities higher, are still at work, except that we have this big problem called the 35 trillion and growing quickly national debt that people have finally started to take notice of, which doesn't, of course, count the unfunded liabilities. And at the same time, we're in the process of getting a Treasury Secretary who is probably the most knowledgeable financial person that's ever held the job, or at least in my career, for sure. Because the biggest problem right now is the size of the debt and the fact that we have to, I don't think we have to have a roll about $7 trillion. That's a lot of dollars. And of course, Trump wants the dollar weaker from a manufacturing standpoint so he can make America great again, but he needs to keep it strong enough to potentially get foreigners to buy or will be willing to hold the debt, even though they have been less of a factor in recent years. So that's kind of the mix. Of course, Trump being Trump means that we get, wild tape bombs all the time. I don't mean bombs that they're going to go lower. Just he makes these comments and says things that, causes motion. So the title of my column earlier in the week was "Make Volatility Great Again." It was obviously a play on MAGA. But the point I was trying to make is I think we're going to see a lot of volatility as a consequence of the way he goes about doing what he does. So that's pretty much the setup as I see it. I don't think it's radically different from what we talked about last time, although I will say that I think the bond market is going to be under pressure until such time as it makes the equity market weak, and then maybe it can get some relief. That's kind of a pet theory that I have. I know a lot of smart people that think that inflation is under better control than I think, and therefore they think the bond market can rally. I don't think the bond market can rally because there's no rule that says what the supposed real rate has to be. And since we don't know what the real rate, what the actual rate of inflation is, it's basically an estimate on, and impacts different people differently. And not everyone is willing to accept the same level of real interest rates. So I don't know that a 5+% yield, or even a 5.50 yield on a 10-year piece of paper is all that attractive. Now, for some instances that may be enough to get the job done, but I think that the bond market is going to be the real problem this year. Equity market valuations are stretched for the big companies that have carried it, but that's all because of the passive bid, which I don't think I need to discuss again. So that's kind of the backdrop as I see it right now.
Yeah, a lot of things in motion. I guess, how does Scott Bessent work this? Because as he said, Trump's talks a big game about government efficiencies, reducing costs, but it's going to be very difficult to actually reduce the deficit unless he's cutting Social Security or something else that's would be very unpopular. Scott Bessent talks about sort of pushing out, I guess, bond issuance further down the curve, but then that's going to just exacerbate the problem even worse. So how do you see him going about this?
Well, that's the $64 trillion question, is how is he going to pull this off? I don't really know. Fortunately, he's a very smart guy and knowledgeable about markets and things like that. But I just don't know. That's the sticky thing, because if the Doge Commission, whatever you want to call it, could find 500 billion or so of cuts, that would be pretty heroic. And I bet they could. Maybe they can find a bit more, but that's not enough at this juncture, given the size of the deficit. And when you look at the buckets of spending, where there's defense and all of the other ones, it's difficult to figure out where they're going to get much more than 500 billion, maybe 600 billion, without addressing entitlements. And of course, that's supposedly off the table. And the problem is, entitlements are always off the table unless we have a crisis. Now, we had a very severe crisis in 2008. The bank system almost went to zero thanks to the bad policies of the Fed and reckless real estate speculation, and that ended in 2008. But even then, we didn't. I thought for sure we'd address the entitlement issues, and we didn't. All we got out of the 2008 crisis was banking regulation that was probably a little too onerous, and we got Obamacare. And neither of which solved the problems that we have. So you tell me how big the crisis is going to have to be before they can touch entitlements. I mean, there's no chance it will be addressed without a severe crisis of some sort, in my opinion.
Yeah, I come from Australia, where they have, and I actually don't know how long this has been, but it's sort of means tested in pensions and other things. So if you own a certain amount of assets, or if you have a certain amount of income, you don't actually even get a pension. And you think that's sort of the way that, I don't know if that's the same in the US, but it's not in the UK. It seems like that's a way that these places have to go.
The only way you're going to get remember, Trump can propose whatever he wants, but he's got to get it passed. And the only way you're going to get entitlements, look at the furor over illegal immigrants that are here that commit crimes. It should be a no-brainer, if you do that you get tossed out of the country and are never allowed back, right? That seems pretty obvious. And yet there's a certain faction of the Democratic Party that says, well, that's not fair. We can't do that. I don't know what their ultimate agenda is, but in any case, if they won't agree to that, which is so obvious, how are you going to get them to cut social programs and things like that, and mean test entitlements in order to cut the size of the deficit without a crisis. People, when I say people, people in Congress have to be scared out of their minds to agree to do that. And if they're scared out of their minds, that means their constituents are. So you need a real crisis to get people to say, okay, look, Bill, you don't deserve Social Security, and we're going to means test it. I wouldn't argue at all. In fact, I expected it to happen in 2008. But then you have to gore everyone's ox a little bit so everyone feels like that they aren't the only ones getting picked on. For instance, another thing that I thought would happen in 2008 that didn't was, why is it that if you're a real estate speculator, operator, developer, whatever you want to call yourself, and you sell a building, if you roll it into another thing, you get to exchange it, you don't pay taxes until the very end. Whereas if I buy a stock and it goes up and I sell it, I have to pay taxes. And we could find, lots of different buckets of money and if you took something from everyone, then no one would feel picked on, but you need a crisis to be able to get that process to work. That's what I think. So I don't see how we do anything meaningful on cutting. That's not to say if they could find $500 billion worth of ridiculous fat that was laughably ridiculous, they can't get that done. But that, unfortunately, we're about 7 or 8, 9 years late on that amount of money being enough to matter. I mean, we've piled up, $10 trillion in almost no time. So, I mean, these are huge numbers.
Yeah, and I think if there's a crisis, you need to have faith in the government to use that money properly, which is, I think, another thing that people have lost faith in most countries. As you said, the waste. And I think I saw something that's spending $1 billion on a embassy in Sudan, in South Sudan, which is, almost 10%. That would be 10% of that the GDP of that country, which is, it's mind blowing. But yeah, I guess, as you said, that's not going to be able to cut trillions.
No. So anyway, Bessent's got a tough job. I think the best hope for the country is that Trump has surrounded himself this time with a lot of people that have serious financial expertise. Now, you may not like all their policies or like the fact that they like Trump, but the fact of the matter is we have a lot of successful business people who know how to deal with problems and that are trying to get involved. The Congress has got to obviously let them be appointed. But so the best hope is that if we have a crisis, which we easily could in the next few years, that we'll have the right people to make sure we get the right policies this time relative to what happened in 2008. Just as I say, the 2008 crisis happened, but then the Obama administration came in and they didn't really there was a tremendous opportunity to do a lot of things that would have put us on a much sounder footing for a long time had they had the desire and the ability to come up with different changes, which they did none of. So, but this time, if we have a crisis, we got the right people, I think, to help us put ourselves on a better footing. So, in other words, we won't waste the crisis like we did last time and the time before that.
Yeah, don't know. It will be interesting to see. So, if we look at, in the near term at least, what do you see happening to bonds? I know you said it's hard for them to fix it, but what do you see happening to bonds? Is just the yield's going to keep increasing, or do you have any perspective?
I think the bond market will continue to leak until such time as we get economic weakness, or if we had some stock market weakness that got triggered for whatever variety of reasons, and the weakness was enough to trump the passive bid, you could get stock market weakness, and then that people would presume that economic weakness was coming, and you get a decent rally, and then maybe there'd be less inflation, so you could get a decent rally in the bond market. But other than that, I think the bond market's going to be under pressure until some kind of a crisis gets people to change their minds a little bit, or if the crisis gets big enough eventually, then you can actually try to solve things, as I've just stated. but I don't. There's nothing there now, so I think the path of least resistance for the bond market is lower, which is to say rates are going to move higher. Now maybe Bessent will come out with something that'll get people excited, and we'll have a knee jerk rally. Sure, that could happen, but there's going to be no meaningful lowering of rates from, call it 7 years and out. I don't believe, unless we get like some sort of, like I say, some weakness.
Yeah, okay. It seems like that's sort of what the Fed are worried about, maybe giving themselves some platform to cut if there is weakness, as well as the animal spirits, you said, with Trump coming in and businesses, starting to spend like crazy and banks starting to actually, loan to businesses as well. So it seems like there's the risk of, overheating economy. And then, as you said, that could go too far.
Well, I mean, the Fed, I think the Fed's made a horrendous mistake lowering rates. I mean, and the bond market does too. The Fed lowered rates 100 basis points, and longer term rates are up, pick a number, 75 plus or minus basis points, depending which day you look at it. At one point, it was 100, and that's been now for almost 5 months. So, it's we haven't seen anything like this in since probably, I don't know, 30 or 40 years, where the Fed lowered rates 100 basis points and the bond market backed up 100 basis points. That's telling you the bond market is not on board with the Fed's decision, and or the supply is too big. But most likely it's the former, because if it was not the case, the supply being too big would somehow not matter.
Yeah, and it's creating an interesting, I guess, trend where dollar's extremely strong, and then I think the rest of the world is, they really need interest rates cuts because they're sort of want to cut themselves, but it's affecting their currency. So do you see this just dollar wrecking ball continuing globally, or do you have a perspective on that?
Yeah, no, I think the dollar rally is about over. And the same thing happened last time. And I think maybe the dollar rally went into February. I mean, we're almost to February. Tonight, as we're recording this, the BOJ is supposed to hike rates. If they do, and the yen rallies, it could be start of a big move. I think the yen is the only currency that's got a fundamental reason to rally substantially against the dollar. The euro is a basket case, and it will be a basket case because of the bureaucracy in Europe and all that. So, but the yen could rally substantially, and I believe Trump doesn't want a strong dollar. If you're going to try to manufacture your way and grow your way out, you need all the help you can get, and a weaker dollar at the margin helps. Now, obviously, it doesn't help. You don't want a really weak dollar because we've got a lot of debt to finance. But I think he, if the yen were to rally a bunch, i.e., weaken the dollar, they're not going to care. I believe the Trump administration, despite what they say about we want a firm dollar for the budget deficit finance, they want a lower dollar for manufacturing, and that's my theory. We'll see if it comes to plays out that way.
Yeah, okay, and I guess a lot of people have been worried about tariffs as well, and the potential for them to bring them in on day one hasn't happened. I think it's sort of day 3 now, so nothing yet, and it seems like it's more a negotiating tactic, maybe potentially the strong dollar as well. I've talked to people who say, maybe they make a deal with the BOJ, or maybe they make a deal with China to weaken the dollar to help their economies. I don't know if you have a perspective on that rather than tariffs.
Opinion on what he's going to do with tariffs, because he postures all the time. So to try to think that you can figure out what he's going to say and what he really means, and then what he can get done and what the ramifications are going to be, is way too many if this, if that, if this, if that. Every time you have a conditional probability, you increase your chances of being wrong. So I don't think it's possible to speculate on. We may get no tariffs. We may get a bunch of tariffs. They may be high. I don't know. I don't see how you can have a strong opinion. And so I'm not going to try to figure out what it means if he does, this or that. Let's see what he says, and then figure out what we think it means, and figure out if we think it can be implemented. And if so, then we can decide what we might or we should do about it.
Yeah, it makes sense. But as you said, you think dollar's potentially topped, especially against Japanese yen. and you see markets continuing to rise until the sort of bond market gets out of control. Is that sort of your perspective?
Yeah, the pressure on equities to the upside is a consequence of the 401k plans in America that are all headed where the money all goes into index funds, target date funds. And this has been a factor that's been at work for some time. And it's now probably 45%, maybe a little higher, of daily activity. And it's what drives the prices at the margins, the single most important factor in the market. So unless something comes along that's more powerful than that, and we could make up what those might be, then you have to assume that the passive bid is going to keep grinding these big mega cap stocks higher, which is what keeps the indices up. Now, that doesn't mean that the fundamentals can't overwhelm them. I mean, but that's the norm right now. And so I think that that the only thing that's obvious to me that can really matter to stocks is the bond market, because if the bond market gets weak enough, then some of these target date plans have to rebalance. And I'm spending a lot of time talking about passive bid because it's the single most important factor in the equity market by miles. And you have to know that that's operating and what it does and what it means for what can work and what can't work. And then you have to layer in all the other variables on top of that. So that's just that's just where we are now and have been.
Yeah, definitely. I heard an interesting point recently where they were looking at, international, I guess, investors. Generally, they used to invest in their own country, mostly, and then sort of invest internationally as well. But then now someone was saying that a lot of the time they find the MSCI, World ETF or whatever, and the majority of that is allocated to the US. So it could be 70% of the US. So it's actually also these, not just the US retirement funds, it's, the global retirement funds are concentrating into the US, and they're going to continue to do that as they outperform other markets.
Yeah, it's a self-fulfilling prophecy. It's in some ways until something bad happens, and the way that the passive bid distorts the really big stocks, which are the ones that everyone is enamored with. And then you get the follow-on buying from momentum funds and foreigners and all that. So yeah, the factors at work are all the most important one is the passive bid from the Vanguard and BlackRock's of the world. I'm not talking about ETFs necessarily. That's a different issue. And then the sort of the kind of the follow-ons things that occur because that's where people reverse engineer from momentum and the factors in those big stocks. And it's really the fact that they're big and that they're heavy. They have a heavy weighting in the index funds, so they get chased higher. And then people think, well, it's because it's Apple or it's because it's Nvidia. Well, it's kind of recursive in that, yes, they did some things successfully to get there, but then they get there and they get powered higher by the passive stuff. So by the passive bid. So it's really a huge factor. And I keep, as I say, I keep talking about it because you have to, if you think something's going to derail that, which at some point it will, you need to know what you're up against, what you're trying to derail. The market that exists today is not at all like the market that existed before 2010 or 12. Back in the aughts, the 90s, the 80s, the 70s. So the market was completely different then as it is today.
Yeah, I guess if I think about it, does that mean that increasing unemployment would have an impact, and maybe even, boomers starting to retire and, starting to have to withdraw money? That could be, these could be other factors.
Both those factors would matter. The boomers withdrawing would be a little harder to follow. You'd have to really pay attention to the data. It's possible. Obviously, if unemployment started to rise or employment started to decline, people would be able to see that. Both of those factors would matter for sure, but they're not at work right now.
Yeah, and it doesn't look like they're sort of going to happen on the horizon as well. So, yeah, but what does this mean
But
for
it's
your own
worth knowing
positioning?
what matters and what doesn't. So I'm aware of what's in play, and what I'll be looking for. If I thought something was starting to change, I would certainly um, put on some shorts to protect what I have this long. And by that time, who knows what I'll have long? It's hard to say, but I would play serious defense. I would get net short probably, but perhaps things I'm long might still work depending on the situation. I mean, I'm long gold and some gold miners. I'm lucky enough to have some of the ones that have done well, not the ones that have sat in the basement. And that, depending on how things play out, they may do very well. I may not need to worry about them declining. On the other hand, they might. So it's impossible to speculate about what you would do, other than if the passive bid were to be swamped, equity prices would head much lower, and you'd have to figure out how you wanted to address that.
Yeah, okay, important thing to look at. So, do you have an opinion on why a lot of the miners haven't performed? Is it just that they're poor allocators of capital, or is there something else that's sort of been impacting it?
No, yeah, I mean, look, mining is a difficult business, but there's a lot of businesses that can be tough. The difference is there's a lot of the functional equivalent of mom and pop miners. When you look at, you have one mine or two mines, it's hard to create real scale. And so there have been a lot of mediocre, and there's a lot of independent mining companies that are kind of quasi mediocre, even though they're doing well now with the price of gold where it is. Um, and but the real, it's not so much the companies or the business, is the fact that there's very little interest in North America in gold itself. The GLD net has lost tonnage last year. In a year, the gold was up over 25%. And so if there's no enthusiasm for gold, if Americans aren't buying gold, why would they buy gold mining companies? I mean, so there has been no real interest in the sector in North America, whereas the driving force behind gold has been central bank buying and buyers in Asia. But a Chinese person who's buying gold for reasons that have to do with financial stability or American mining stock. So I think that's the problem. At some point, that psychology will change. Could change tomorrow, next week, whenever. So we'll just have to see. But that's been the case. Gold's gotten to where it has with almost no participation by people in North America.
Yeah, and I guess traditionally it's been more a speculative asset, and now you could say it's competing against crypto and sort of tech and these other industries.
No.
No?
No. When I first got into business in 1980, after we got through the 60s and 70s, it was deemed to be prudent to keep somewhere between 0 and 10% of your assets in precious metals. That was meant to be a prudent thing to do. Why? Well, because inflation was caused by central bankers, and look at all the currency turmoil and problems that have been created by the central banks. The antidote to that is to own gold, because gold is the reciprocal of confidence in the government or the central banks or your safety or things like that. That's what people that don't have confidence in those things tend to buy gold to protect themselves. And it was deemed to be a prudent thing to do. After Volcker broke the back of inflation in the early 80s, inflation hasn't been wasn't on people's minds in any serious way until after the craziness that the government pursued in the wake of during COVID. And the Feds totally mishandled the their interest rate policy this whole time. As they've done a bad job for 30 years. But so gold was deemed to be like an anchor. It's a monetary anchor. It's not necessarily speculative. Now, chasing the price around is a speculative activity, and speculators do chase prices that move. So it can be a speculative asset, but at its core, it is not a speculative asset, unlike crypto. Because you can take a gold bar and walk around with a gold bar and take it anywhere, and they know it's a gold bar. It's very difficult to counterfeit, which is one of the reasons why it's been a store of value for thousands of years. Well, you walk around with a Bitcoin, and without the network, what are you going to do with it? So Bitcoin is far more speculative. I mean, I'm sure I'm going to put Bitcoin fans' hair on fire than gold is, but that's a fact. Bitcoin needs a network, needs things to support it to be able to use it or move it around or speculate on it. Gold does not.
Well, when you started, were the miners to the gold miners speculative, or because I guess that's sort of more what
yeah, gold miners are more of a that's more of a speculation on the price of gold. And as a smart friend of mine said to me the other day, gold miners are like insurance. Gold is money. Gold miners are they're speculative, but they're like insurance. But it's not fire insurance, where you need your house to burn down to get paid. It's more like life insurance, and you're 90 years old, and they're pricing it as though you're a 20-year-old. And so was trying to capture the risk reward opportunity and the fact that in times of stress, a lot of times gold does well, and the miners do too. Now you got to remember the mining, the market cap for the entire industry is very small. I haven't checked it recently, but it's the total market cap is 100 billion plus or minus. That's the Trump coin, for instance. I mean, it's just so it doesn't take much money to move the sector. And when people decide they want to get in and they start trying to buy them, you can have a lot of price appreciation in a short period of time because there isn't that much market cap. But when no one cares, they just drift.
Yeah, which is what they've been doing since sort of 2021. Or not all of them, but a large majority. But yeah, I'd be interested if
GDX. The GDX itself has kind of done that. Some of the others have done quite a bit better, but in the main, it's the industry has not been rewarded for the change in the price of gold.
Yeah, definitely not. So I'd be interested to go back to your perspective on what you were saying with gold used to be a key part of most investors' portfolio. Do you think there needs to be a shift away from the 60-40 portfolio that's been so successful over the last 40 years? Is the inflation coming back, meaning that, it should be 60-30-10 in gold, or even 60-20-20, or what are your perspectives?
Yeah, I think 60-40, the classic 60-40 portfolio is going to have trouble, because I think the bond part's going to have trouble, and therefore I think that back to where we started, the bond market is a problem. I don't think it's going to be easily solved. That is the size of the deficit and the national debt itself. So I don't see. I think the 60-40 portfolios is not going to be not really going to work that well in the next several years.
So would you think it's sort of more just people should, obviously this is an investment advice, but people should own less bonds, obviously, and more gold and equities.
Well, everyone's different, though. I mean, I think the bond market doesn't offer that much value. Now, if you are not sure what to do in stocks and bonds and you hold cash and you're getting paid 5% roughly, or a little less, that's not offensive the way it was when they're holding rates at zero. But and that doesn't mean that if you've got a lot of money and you're close to retirement, that having some amount of the money in the bond market to get the fixed income from it, it doesn't make sense. But to be a true help to the portfolio as it was, as bonds were from say 1980-ish, 82-ish, until maybe 4 or 5 years ago, that it's not going to be like that. I think we're in a generational bond bear market. Interest rates are going to be generally rising, so you're not going to have any capital lift, and your coupon's going to be eroded by inflation more than it has been in the prior 20 or 30 years. So I think bonds are not going to be very interesting until enough people are saying it the way I am, and then it backs rates up to a point they get attractive, and that'll be a different issue.
Yeah, we'll have to wait and see. So, Bill, thanks so much for your time today. Really appreciate it. Last question is, what is one message you want people to take away from our conversation?
I would say the most important thing is to make sure you understand the passive bid and what that does to equities. And then now that we've got the Trump administration in place, you have to be very careful about making decisions and expect plenty of volatility, because there will be a lot of trial balloons and won't mean much, and the tape's going to move around on that, and you can't let yourself get shook by actions created by rumors or policy trial balloons that aren't going to come to pass. So be very judicious about what you believe and act on, and realize that the bond market's got a problem, but then you've got the passive bid, which doesn't care, and you got to mix those variables up and come up with a plan that'll work for you.
Yep, great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
You could go to my website, fleckensteincapital.com. I write a column every day and I answer questions. It's a pay site. It's about $12 a month. Not too expensive. If you want to follow me on Twitter, my handle is @FleckCap.
Perfect. I'll put it in the description below, but thanks again for your time.
All right, Anthony, thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.